So Andrew Carnegie once said, the wise young man or wage earners of today invest his money in real estate. And Mark Twain has once said, buy land, they are not making it anymore. Louis Glickman, who is one of the prominent real estate investors of all time, says the best investment on earth is earth itself. So in today's video, we're going to talk about why real estate is the #1 vehicle in building financial wealth. Hi, this is Heather Lynn with Keller Williams Realty. Welcome to my channel. In this channel, we talk about real estate trends, real estate updates, and what is it like to live in the San Francisco Peninsula and Silicon Valley neighborhoods, how to sell your house for top dollar, and much more. So if you're interested in that content, please subscribe to my channel and hit that notification button so there will be new videos coming your way every week. Help hundreds of families buy and sell real estate here in the Bay Area, and I would love to be of assistance to you and share my knowledge and expertise with you. Let's get into it. So when you buy a home, usually people buy it with the combination of your down payment, which is usually 20 to 25%, and the other 80 to 75% comes from the bank. So the only money that you're coming up with is your 20% to buy that home that's worth 100%. But guess what? When it appreciates, when it increases in value, it increases the value on that 100% of the home value. So your 20% is making you multiplies of returns on that money. So that's the #1, is that real estate, when it appreciates in a way that gives you a great return. Let's also talk about some of the tax advantages. In the United States, Uncle Sam's created many tax incentives to encourage people to own homes. After all, home ownership is, one of the American dreams. So one of the biggest tax incentives is the tax exclusion benefit. What is the tax exclusion? Let's say if you buy a home this year for $1 million, and then 5 years later, the home is worth $1.3 million. That $300,000 home appreciation is excluded from capital gain taxes. So when you file your taxes, you could exclude that and then really pocket that money for the down payment of your next home, or just use it for your personal use. Now that tax exclusion is $250,000 for individual tax filers and $500,000 for a married couple. So you could have appreciation up to $500,000 without having to pay Uncle Sam a cent on taxes if your home appreciated that much at the time you sell. So that's another biggest incentive in terms of tax benefit. The other tax benefit is that every year you could deduct your mortgage interest payment and property tax payments against your income tax. Here in California, the state had capped that deduction up to $10,000 in terms of how much you could deduct. But nevertheless, that's still another great tax incentive. The other tax incentive is that if you own an investment property, you could expense everything that's affiliated with that property against the income you're getting on your investment property. For example, like I mentioned earlier, property tax is 100% your expense to run this investment property. So that's completely tax deductible. Your insurance, your management costs, any improvement you made to the home could also be depreciated over the span of 27.5 years. So every year, if you own the investment property, you could deduct a lot of expenses against the monthly income that you get from your tenants. So that's another way to pay minimal taxes while seeing your property appreciate over time. And again, remember that when you buy that home, all you have to put down is that 20% or 25% of your own money. You're actually leveraging the bank's money for the home you own, and when the home appreciate on the entirety of the value of the home. So I just want to kind of emphasize that. The other obvious benefits is that if you have read the book Rich Dad Poor Dad by Robert Kiyosaki, he's an advocate of real estate investment and owning good real estate portfolio portfolio. Why is that? Because when you buy a home, your mortgage payment is fixed. Most of the mortgage payments are 30 years. So that mortgage payment is fixed for 30 years at that amount. But the rent, you could charge more over time. So eventually, not only would you realize a gain on the home value, you will also get a cash flow. So that's how a lot of people build their wealth, by owning multi-unit or investment properties over time, is that could be their passive income. That could also offset their income taxes. And then obviously when you sell, you could either take advantage of the tax exclusion if you live in the home as a primary residence, or in the case of an investment property, you could do a 1031 exchange and defer that capital gain to another property. You should do another video just on that topic, on 1031 exchange. So homes usually appreciate if you hold it long enough. Between 2021 and 2022, here in the Bay Area, homes appreciated between 15 to 25%. So many of the property owners, if they have bought the home more than 2-3 years ago, their home has appreciated to a value where they could have enough equity to take out another loan called HELOC, which is home equity line of credit. And the home equity line of credit is basically bank financial products that allow you to take excessive value of your home out in the form of a cash, and that you could use it towards home improvement, or you could use it to pay for your daughter's wedding, for your kids' education. You could take advantage of the home equity line of credit when you have realized equity on your home. So that's another big advantage. So if you have already owned a couple of properties, I'm curious, what's your favorite part about real estate investment? Comment below and let me hear your thoughts on that. So I know we've been talking about a lot of theoretical benefits of real estate investment. Let me give you a real life example. Last week, I helped a client sell his home, which he purchased 3 years ago for $1.3 million. And 2 weeks ago, we sold his home for $1.9 million. So that means that in less than 3 years, he is able to profit $600,000. That's before tax. But let's keep in mind that when he bought this home for $1.3 million, 3 years ago, he only put down 25% down payment, which was $325,000. That $325,000 he put in 3 years ago earned him $600,000 at the end. So what's the rate of appreciation? That is a 46% appreciation in 3 years. And the annual appreciation is 15.3%. every year if you average it out. So his down payment is making him 185% in return in 3 years. So that average out to be 61.5% annual return on investment. I don't know what you invest in, but I have money in stocks, I have money in ETFs, I have money in mutual funds. None of them were making me 61.5% return on my money. So in my mind, real estate is still my #1 most favorite investment vehicle. So if you're interested in learning more about what type of properties could you afford and what are your options in terms of bank loans with the money that you save up for down payment, give me a call. I would love to walk you through your options within your budget in terms of real estate purchases. So if you want to know more about this particular client and how his home was sold, watch this video right here.